Vetri Subramaniam joins us, CIO with Religare Invesco Mutual Fund, someone who has seen many of these tough cycles in the past. He's seen 2001, 2003, 2008. Vetri, how much of the current selling in global markets and local markets is a function of pure vanilla sentiment?
Well, I think, the Indian markets are, affected by what happens globally, because not only do we have a significant part of our economy which is export driven, but more importantly, 24% of our stock market belongs to foreigners, and therefore the transmission channel from one financial market to the other is something that we can't wish away. But I think, having said that, I find these laments about foreign sentiment a bit misplaced. In the sense that if you look at the last 24 years of data for foreign inflows into India, this will perhaps be only the third financial year in which inflows may turn out to be negative. So if anything, they've actually been pretty consistent in terms of pouring money into India. And secondly, I think we have to recognize that as far as India is concerned, our macroeconomic stability might be good, but the fuel for equities is eventually earnings, and earnings have been disappointing. I mean, a year ago, I think consensus expectations was for a middle or high teen earnings growth for 2016, and as we get to the end of this financial year, it looks like eventually we'll finish in the low single digits. So I think to just blame global sentiment is sort of missing the specifics of the story, and which is that India's earnings growth remains a cause for concern.
Vetri, it's very hard to assess what's going on with the global setup. Some are worried about China, others are making a concern that the selling in oil will be disruptive and sovereign funds will be selling more. Concerns about what US economy will do, they've come to fore once again. So what's going on with the world? I mean, if you ask a bear, the bear would say that, look, this is end of the world. So what is your assessment of what's going on?
I think you mentioned this in your opening comment. I've been in the market 20 plus years now, and from 1994 onwards, every few years you go through this pattern where the world starts to obsess about some issue, whether it was the tequila crisis in 94, Asian crisis, LTCM, .com, commodity meltdown, 2008 global financial crisis, then you had the European sovereign crisis. So I think these are realities that you have to deal with, that as an equity investor, if you look at any 5-year, 10-year period, there will always be some kind of global disturbance, etc. But every now and then you also get periods of stability, you get periods of high growth, you get periods of innovation, you get periods where India starts to do relatively well. And I think as equity investors, you have to sort of cut out a bit of this noise. I'm not saying you can completely ignore it. To my mind, the current takeaway from what's happening in the rest of the world is very simple, which is that India remains, in a sense, on a stable macroeconomic platform, as RBI said yesterday. But really, in terms of growth acceleration, it is challenging, not only because of domestic factors, but also because global growth is not supportive. And we have to recognize that India's best growth, which came during the period 2003-2008, was a period during which global growth was extremely supportive, and exports actually contributed very significant delta to the increase in our growth rates. That is slightly hard to imagine at this point of time, simply because global growth is weak. So I think that's the reality that we have to deal with. And if we can still get 6.5-7% kind of GDP growth rates, I think that's something to feel reasonably happy about at this point of time. And you just need to sort of be patient to see when global environment turns a little bit more conducive and can actually add to India's growth by providing the additional growth through the mechanism of exports.
Vetri, so, describe the panic for us right now. You've clearly talked about the times that, we've seen a crisis like this emerge in the past as well, and the markets have come out strongly, and we've had happy investors thereof. But does it seem like, this could get a little worse, because we are beginning to see redemption from DIIs already, and, they as a class have been supporting the market all of 2015?
It's sort of hard to, focus on fund flows or forecast fund flows. It's hard to forecast anything, and I think the most difficult thing to forecast is fund flows, so I don't even go down that path. But I would only put this in context. I mean, go back, as I said again, if I look at this market over the last, 20 odd years that I've been investing, you'll rarely find a 3 or 4 year period during which equities at some point of time did not correct, 25 to 30%. People forget that even during, the bull market of 2003, 2008, it was actually interspersed by 2 corrections of 30% each in 2004 and 2006. I'm not getting into a definitional thing of whether this is a bull market or a bear market, but 30% falls are not unusual for the Indian market if you look back at history. Can it go lower? Sure it can. The only prism through which we look at markets is valuations. A year ago the market was trading at almost a 25% plus premium to its long-term average valuations on a trailing basis. The good news is that it's now dropped back to pretty close to long-term average valuations, maybe just a 3-4% premium. But how bad can it get? Again, go back to history. You don't have to go too far. If you went back to 2013, the market was trading at almost a 13% discount to its long-term average. But I would feel a lot more constructive about equity now because you're closer to those averages. And again, expectations have fallen off. I think, you mentioned this in your opening comments, that, expectations were very, very high post-election, and that's true, and that caused valuations also to therefore trade very high. What I like about the market today is those expectations have eroded dramatically, and now the valuation premium is, not as expensive as it used to be 12 or 15 months ago.
Vetri, what about the growth environment? And I'm looking at the local growth environment. Private sector capex has not picked up. NPA concerns are clear and visible. Agrarian economy is under pressure. Urban consumption, I can debate both ways. So my question is that what will be our out of jail card?
Well, I think the out of jail card is that you haven't had a full-blown crisis in India. Just look at what's happened to most other emerging market currencies since the taper tantrum crisis in 2013. It may come as a surprise to you, but from August of 2013, the Indian currency is down barely 1.5%. Almost every other emerging market currency is down between 25% to 50%. So I think, our macroeconomic stability is a very hard-won success that we've had over the last 3 years, and we should not ignore the fact that that is what has saved us from a far worse outcome that many other emerging markets are experiencing. Now, coming to the next part, when do we actually start to grow? I think it's a gradual process, and if I take my memory back again to the late 90s period, because I see a lot of similarities between where we are now and there, then I think, if you look at the late 90s, we went through a period of deleveraging in the late 90s. And then it was only in perhaps 2002, 2003 where gradually we started to see the new capex cycle kick in. I think right now we are at a point where the deleveraging cycle in India is just starting to take hold. Not only because entrepreneurs are finally seeing that there's no way out but to deleverage, but also because government, RBI and banks are putting pressure on them. So really, can you get capex when a lot of your corporate sector is still over leveraged? The answer is no. And therefore, when you start to see deleveraging happen, you can then hope that somewhere down the road, once that mess in terms of excess debt has been cleared up, at some point capacity utilization rates start to go up, and then the virtuous cycle of growth starts to kick in. I don't have visibility on when that happens, but that is the normal economic cycle, and therefore our thought process right now is just to be patient and wait for the cycle to sort of move a little bit more favorably towards the upside. But first comes deleveraging, and only then comes the capex cycle.
Going to recover the fastest according to you, Vetri, because all sectors across the board seem to be falling like nine pins right now. There seems to be a fundamental dynamic problem with each of them.
You're right on that, Aisha, and therefore our thought process on this right now is not to get lost so much in trying to figure out which sector will revive faster or quicker or better, but really to think about this more in terms of which are the companies which are coming through these difficult times, still standing tall with balance sheets which are fairly strong, maybe experiencing some level of P&L stress, But if they come through this difficult period, we think that as and when growth starts to recover, these will be the companies at the starting block which can then start to go for growth in a very aggressive fashion. So really our thought process right now is more in terms of backing the companies that we think will still be at the starting line when growth starts to recover. The most dangerous thing for us as investors at this point of time is to get stuck in companies which don't even make it to that starting line when the starter's gun is fired. So really our thought process is to back companies at this point of time rather than get caught up too much in terms of sectoral thought processes.
Let me get a closing comment from you. When there was chaos in the world in 2008 and when world was looking settled in 2009 and 2010, growth investing made a comeback. Your FMCG names, pharma names, companies which have a natural moat around them, typically companies which fund managers they love, they were the flavor of the moment. So what is the way forward for typical high quality companies now?
Well, I'm not going to forecast how they will behave, but our thought process at this point of time is that, we would obviously eventually we buy equities because we want growth from the companies that we invest in, but, we are willing to pay only a reasonable price for it. We are not willing to overpay just because of a supposed, moat or their defensive characteristics relative to perhaps what some economically sensitive businesses are experiencing. So I would say eventually, obviously, we want growth, but it has to come at a reasonable price. We are not willing to pay, for argument's sake, nosebleed valuations just because it looks to have a so-called moat. I mean, to us, I think margin of safety is an equally important concept which has been forgotten in the pursuit of, high-quality investing, which has, certainly played very well over the last 3 to 4 years. We still don't compromise on balance sheet quality. Because we think that's paramount if you want those companies to still be around and participate in the next growth cycle. But P&L pain is something that we are willing to tolerate.